On this episode of Pennies Going in Raw, we discuss how to bounce back from a down week, the stimulus news, how to hedge properly in this kind of market, the CCIV news, and how to handle swings that are down a lot.
Hey, yo, check 1, 2. This is Flavor Flav in the building for the Atlas crew.
Atlas Trading, what the fuck is up?
There are traders, there are prodigies, and then there's legends.
We're up 4%, baby.
No way.
4% Buy the fucking dip.
Hey, who told me about IDEX?
Like, dude, what the fuck? Like, someone just made, like, a lot more money than me on my trade.
You find out life's this game of pennies.
Did you check the portfolio?
Pennies. The margin for error is so small.
I bet Warren Buffett never did that.
And they out there making money right now off of penny stocks.
Them two guys is putting in work to make y'all rich.
The pennies we need are everywhere around us.
It's time to think big.
Pennies Going in Raw.
Featuring Dan, Deity of Dips,
and Hugh Henne.
Produced by Vinny Strokes, baby.
Welcome back to Pennies Going in Raw. This episode is brought to you by Benzinga. Benzinga has our favorite scanners, news alerts. It has everything you need when you trade to ensure you are at the top of your game. But it doesn't just stop at their app, which you can get 2 weeks free at pro.benzinga.com. That's pro.benzinga.com for 2 weeks free. Their YouTube channel, every day, Monday through Friday, they have Power Hour. They have every single day a live stream where they have guests on. They talk about the news in the stock market, and just the guests are incredible. They've had Mia Khalifa, great podcasters like Dan and Hugh Henne. They have other great traders like Ripster and just a bunch of people that you just would love to hear from. So make sure to check it out at youtube.com/Benzinga. Welcome back to Pennies Going in Raw. Today is Sunday, February 28th, and I think it's fair to say a lot of people had tough weeks, and I think we should at least try and get everyone recouped. But I think before that, to start, how did you handle this week? I know you're a big swinger, and everyone saw your post that was saying you were down $2 million at one point. What was that like, and what was your mentality like just going in for that?
Yeah. I mean, that's a question that I've been getting a lot this week. And I think the biggest thing is that it goes back to the scaling point. Obviously, that would have been my biggest red day ever. And the way that I kind of looked at it was, okay, did anything change from my strategy from when this amount of money was, let's call it the $20,000 or even the $3,000. And so when you have a system in place and you follow that system, it could have been 100 million. And as long as I followed my strategy, I was confident. So obviously you don't like seeing that. But what I did was I did what I always do, which is on big, massive flushes, I buy the flush. And then once things settle out, which we saw, I guess it was Wednesday was the big flush, and then Thursday we saw like a little pop back.
You saw a little recovery. Yeah, I thought the recovery was a lot better than I expected. But yeah, and so you bought those dips. Do you sell those for a little bit of profit on the Thursday? Okay, so you sell those for profit on the Thursday. So your main position is still. You're probably still down on it a little bit because of the action that went on, but at least you got some extra cash from it, and the dip wasn't as crazy.
Yeah, exactly. And so I'm actually making a little bit of money from my core position, and then I scale back out. So I'm always having constant cash. But the important thing.
So you didn't feel like you needed to scale out, like get more cash. Like this week didn't scare you at all to that point? No, I mean, I'm not trying to fear monger, but
no, because we understood that this market's playing with fire. I mean, the market from I think it was 2000 to 2012 had only gone up about 15%. Since then, it's up like 100+%. So we knew that we were playing with fire. And I think the most important thing is that, I get a lot of questions about, should I buy this dip? Should I buy this dip? And one of the things is that incorporates into swing trading is that you wait for confirmation that the dip is curling. So you don't want to buy anything that you see red because it could keep dipping. But part of my strategy is that say I keep about 40% in cash, maybe 50%, then, when I see those dips and I start to see the curl coming back and I see confirmation that, there's a new support in place and that it's curling back up, that's when I hammer it. I hammer my position.
Did Thursday, though, not like, do you think that kind of acted like a pump fake? Because you saw how Friday, a lot of that stuff dipped again. And did Thursday just not confirm those supports?
I'm not confirming it for the overall swing. I'm confirming it on the flush. So Wednesday, we obviously saw a massive flush. I think most of the small caps were down 30 to 40%. And so I'm not buying that initial flush. I want to see it create support and then start to curl back up. And then when it curls back up, what I'm doing is that and this is my personal strategy, I go heavy. Okay. And then when I see some signs of we talked about range, when I see signs of resistance, that's when I take out what I had already gone in heavy. So for instance, think of it like this. I had 10%, say I have 10% of my account into something, let's call it stock ABC. On that initial flush, I'm not adding, but then on that confirmation of the curl, sometimes I'll even triple up the position. But what I'm looking for is only like a 10% bounce back. Let's call it 10%. It can be more, it could be less. And then that's covering my loss and I'm making a little bit of money. And then I scale out for risk management purposes in case we see something like we did Friday.
That's what a lot of people may have been tricked out by. I know I had people, because even last week I had mentioned I am heavy cash. I'm just going in and out of things. It just felt right at the time. And thank God, because like selling out of swings when you're down on them and even just like down on the day, it's tough. You feel like, oh my God, this is such a good buy. I wish this could be my first buy and I could buy them all right here. And it feels silly to sell them. But at the same time, I think it's a good thing to think about is when would you ever recommend some of these people to start cutting? Would you say just the people that are worrying a lot to cut them?
Well, one thing is going to be always like mental health. You never really want this stuff to keep you up at night. Sometimes the market can naturally just keep you up, but you never really want to be just stressed out about a position because that means that you don't trust your strategy. So I think that's number one. And then number two is that if you have no cash to play with on the sideline, take this as a learning experience. So if you have 90% of your account inside the market, you don't have to sell everything. Just scale out a little bit and have some cash on the sideline just in case things do get dirtier. Because we don't know what's going to happen to the market. Next week we could be at 420. Next week we could be at 320. And the point of trading is not to guess. It's to be reactive and give what the market gives you. So the market's been super bull the last year. So everybody's been super bull. So you could have that strategy of keeping all of your money on the street. But now that we've seen the tide change a little bit, it's important for the people that never have cash on the sideline to have cash on the sideline. So if you had 90% of your account in, take and you've taken a 10% cut on your portfolio this week, let's call it, then this is a time for you to say, okay, I 5X'd my account. Now I took a 10% hit. Let me scale out of some positions so that I have some cash on the side. You can always buy back, but you can't keep buying the dip and buying the dip, especially if you're just buying any dip. One of the most important things as swing traders is planning your entries. And so I just kind of touched on it, was letting it create support and then curl back up. Or on the bigger timeline, planning out your buys. Let's call it, the stock's at $50 share. You want to buy at 40 and you want to buy at 36 based on the chart. So, take this as a learning experience if you have no cash on the sideline.
Yeah, I think just keeping cash on the sideline in the mentality that you have differently, the bigger the cash you have on the sideline, the different you see things completely. This was one of the first times ever this week that I've woken up with damn near $0 in the market. If anything, it was just like options that are just far out that, no point in selling those. They're damn near worthless anyways. But just waking up and knowing, because on my widgets, right as I wake up, I see SPY and I'm like, damn, this looks bad, but at least I don't have to worry. This may be a good dip. I mean, this may be just an easier day. So if you're really struggling whenever you wake up, you're scared, you're waking up to red every morning, and it's really just affecting your mentality, I think that is definitely the time to think about scaling back without a doubt. Because I mean, right now, I mean, we mentioned it last week. That was like the first week the market wasn't just piss missiling upwards.
Yeah.
And then this week, you saw what happened. I mean, I couldn't imagine having a ton of money in the market this week. I mean, when I saw you, whenever you messaged me and you're like, are you down? And I was like, a little bit. And you sent me how much you were down. I was like, oh my God.
Yeah. Well, that's the thing is that having that process, I had finished the day down.
Before you get into that, speaking of process, could you walk us through how you went from down 2 million to down 100,000 or down 50,000, whatever it was? Because I mean, that is quite a recovery.
Yeah. So I mean, part of it was, like I said, is that it kind of comes down to knowing the market a little bit. So when I saw the confirmation, I went heavy across the board. I wasn't going to hold my position, so I'd gone from like 53% cash to on margin for like 10%. And we always say not to go on margin, but this is, when I see confirmation, I'm hammering it.
Drastic times call for drastic measures.
Yeah. And at this point, I've been through, things of this nature a little bit. So I trust my strategy. So when I saw that, I hammer it. And then, like I said, is that I'm not looking to hold all that because, again, the market could go down lower. So, it flushes, it gets confirmation. I hammer it. And then, we saw Thursday, we saw a great bounce back and I was out. And now I'm back to my core position. And so I'm always making a little bit of money, but I'm always having cash on the sideline. I think that's the most important thing. Something like Vissel is coming close to its market cap to how much money they have on the street. I want Vissel to go lower because that just gives us a huge opportunity. Instead of making money from 3 to 6, if I can get 2 to 4, I mean, that doubles my money. And I know what it's worth.
Yeah. And the thing is, because I know everyone's going to be responding, 3 to 6 doubles your money too. Yeah, but 2 to 4, you can buy a lot more at 2 than you can at 3.
Exactly.
And another thing to think about, you said one thing that was super important was keeping money on the side. But another thing about your story of Wednesday is you're primarily a swing trader, but you had to, word to the avatar, master all elements. You had to day trade to basically get that back. You loaded the dip, you used technical analysis and basically day traded. And I know you even mentioned on Friday that you were just trading SPY options mostly that day.
Yeah. And even those days I was trading Tesla and SPY options. And, when I'm good at options, I'm good. And when I'm piss poor, I'm piss poor. So that had definitely helped bring me back. I had made a good chunk on SPY and Tesla.
Yeah. But I think that's such a big thing is just knowing just different strategies. I mean, when swinging's working. And when it's not, it's not. And on a day where, like you said, swings drop 25, 30%, being able to day trade and knowing when the dip is in. Because I think the biggest dip was actually like 5:30 Eastern time. It dropped down to like 381 or 370, just something way lower.
Yeah.
The dip was massive. I mean, I think UWMC went down to 670 or something, just baloney low.
Yeah, no, exactly. And I think that you brought up a really good point. And if you guys are newer, because obviously so many different traders have entered the market, we had touched on it, but when I am down on a position, I look at it market tuition, I go back and see what could I have done better. And sometimes you just can't, sometimes you just look back and you're like, I wouldn't have done anything differently in hindsight. And that's okay. This game has no ceiling on your income because there's no floor. And I think that that's really important. I see a lot of people beating themselves up. And sometimes it just is what it is, Sometimes you just catch the market at the wrong time. And that's why really starting out with beer money, Willie Meatsall, shout out to him because he sent me a really nice message that because of August, I think it was last year, year, even this August, he was ready for this. And he at that time, he didn't have tons of money on the sideline, and he understood the difference between pushing it when you have the hot hand and when things aren't hot, keeping 40-50% of cash on the sideline.
Yeah, and I credit August and a little bit of September a lot for knowing how to handle this one. That's exactly why I kept saying I am heavy cash, because August was a mixture of things. It was not only just bad downtrend for pennies, but also the one SPAC everyone was in, SPAQ, which is now Fisker, was down, and it was going down, and everyone was adding dip. I mean, you see it pay off now. It hit $27, or maybe 30. I mean, you're seeing it pay off now. Great long-term swing. It dipped down to 8. But I mean, I didn't want to get caught in a lot of these SPAC downtrends that just kept dipping and dipping and dipping. And that's why I finally said, hey, I've got to go full cash, but that's me. And yeah, I do plan on re-entering. I really would like to re-enter. And that's kind of how I'm playing these dips throughout, like, my Roth or like my longer term account.
Hey, Roth. There we go. Yeah. And last thing, before we move on, if this is your first penny market cycle, okay, what I want you to do is, one, learn from this. Okay. When I used to be the kind of guy that used to keep 99% of my cash until something like this happened to me. And guess what? I looked back at my account and I said, hey, you know what? I'm still up 400% inside the last year, So even though I think at the time I had taken like a 22% hit on my account, and I was like, okay, you know what? I got punched in the face, but I did pretty damn good. So learn from this so that next time because August will probably, let's say that we do see a bigger correction inside the future, or, another slow month like August. Now the value of having money on the side.
Yeah. I definitely see what you're saying there. And yeah, I think that'll be good for now, but I think it's a good time to move into like what's next,
Yeah, definitely.
And I think what's next, or the biggest thing that's what's next, is the stimulus checks. That the news came out, they passed it, $1.9 trillion, $1,400 for, the great American people. This has got to be good news for SPY, right?
You would think that, but let me walk you down a path, Dan. Okay, the market for last year has essentially doubled from the lows. Okay. Why? Because everybody says because the Fed's pumping money, because, because that huge dip, everyone was buying, now there's more money in the market, things of that nature. The other thing that the market's been running on is stim news, is the waiting for this massive stim news. First, it was 5 trillion. Then we're looking at, a few billion, things of that nature. Now we finally got it. So think about this question. What else does the market have to run on?
Well, I was hoping it'd be this stimulus news.
Well, that's the thing, is this going to be a sell the news event? I think there's a chance that it might be. We talked about SPY is sitting right at support.
Well, one big thing, a lot of sell the news is always like a big thing in stocks, but most news doesn't give every trader over $1,000. So wouldn't this money still get rotated into the market? Still good news for what, meme stocks?
See, that's the thing, is that most traders feel, they're like, oh man, like if everybody adds $1,000, hello, the market is run by 80% of algos. It doesn't matter if everybody added 100 grand. These algorithms are way stronger. And that's the difference between traders and people that understand the market. Okay. It doesn't matter if everybody added any money that they had, went on margin, etc. It'll only reflect the market for so long before the algorithms take over, and they're 80% of the market. So we would have to essentially the amount of money that's inside the market by retail right now would have to 5x. And I don't think that's going to do it on $1,000.
Yeah. So it'll definitely be interesting to see. I think that is a Alex Jones conspiracy theory type of thought process behind it. But That is definitely like a crazy way to think that everyone getting all this money is going to be sell the news. Do you think? I think it may go heavy into the meme stocks.
Yeah, that's definitely a possibility. I personally, I think it's going to be two different scenarios. One scenario, because again, we're sitting on support. So this is a pivotal week for SPY. There's no doubt about it. This is a pivotal week for SPY. Right now, we're sitting inside a range of about 360 to 400. And until it breaks one way or the other, where we're sitting right now, about 380 is pivotal. So I see two different scenarios. One, the algos say, okay, fine, last week was tough enough, let's go to 420. Or they view it as sell the news and we're at 360 in no time at all. I would say maximum 2 weeks. Because again, we're sitting at support. So this support could either be a launch pad or this could be the floor. And I think it's going to really depend how the market views this stimulus news. If all this buying pressure comes in, then fine, we'll be at 420. But if they view this as a sell the news event, then because again, you have to expect the unexpected. That's the most important thing with the market. Whatever you expect it to do is usually not what it happens. And it took me a long time to realize that. We thought that the great crash was coming, that at the end of the year, by the end of the year, SPY would be at like 100. What happened? Yeah, did we see a dip? Yes, we saw a dip. And then we saw a double from there. So I think it's really important that, you have to keep in mind, let's see how the market takes it, because the market could take this as a bad sign and that the market doesn't have anything else to run on. Or Biden is already talking about another stimulus coming soon. So the market could view this as a great thing and we could, be at over 400 very soon.
And it's interesting you kind of talk about, expect the unexpected. Like if it does crash or takes a dip or even just a pullback or even just has a shaky week like it did this week and I'm overexposed. I feel like hedging is such an important thing. What are some ways to kind of prevent losing 30% like I hear so many people had an issue with this week?
Yeah, definitely. And we can, it really, hedging, you have to ask yourself, what am I hedging? For instance, I know traders who, let's take me for example. I trade primarily small caps. With those small caps, we saw some small caps go down 50, 60% this week, and SPY was only down 5%. Even if I went all in on SPY puts, it probably would not hedge against my exposure on the small cap side. So what you need to ask yourself is a really important question is,
if you went all in on SPY puts, then what money would you have had in the small caps to begin with?
Well, that's what I mean. When I mean all in, I mean...
I'm just playing. Oh. That was stupid.
Okay, yeah, I should have said, the cash that I have left. But
I'm just playing around. Yeah, go ahead.
But... So if your small cap exposure is massive, you're not going to hedge with SPY puts. Now, first I'm going to talk about if you have a bigger portfolio, because this is important for even if you're not a trader, but if you're investing. For my parents, they have what's called, they have a long-term portfolio, and then they also have an entire portfolio just for hedging. So what this means is that their one portfolio is purely long bias based. That means that they're only waiting for these things to go up. But because they don't want to get screwed if another 2008 or a 29 comes, something like that, what they do is that they hedge with an entire portfolio. It's only about 1/10 of the size of the other portfolio, but that portfolio is always hedged. So they do SPY puts and VIX calls, and all they do is that they constantly roll them, but they do a spread. So when you do a spread, you can what you can do is with the spread is that you can basically subtract theta if you do it right by doing a 2x1. And that's a little more complex, but basically think of it like this, is that they just keep rolling the hedge so that eventually, if something ever does happen, like the market gets pulled or a rug pull like last March, then what will happen is that hedging portfolio will essentially 10x. So right now they're losing very, very little money inside the hedging portfolio. But if the rug ever gets pulled, that'll ever 10x. So even if the other portfolio, let's say, goes to zero, then they're still going to be at the same amount of money. But inside their long-term portfolio, they're never, because of the way that it's diversified, most of those stocks are blue chips. So, we're probably looking at worst, a 70% pool on the blue chip side, but the other account will at least 10x. So that's how you can kind of see that they'll still make money, even though the other portfolio is down 70%. That's how you hedge on the long side, okay, on using blue chips. Now, as primarily small cap traders, we cannot do that same because you can't just hedge against CCIV, not directly. So what
you can buy puts.
Yeah, you can buy. Yeah, so against your long position, you can buy puts, which is a really good example of how you can do that. So if you're heavily invested inside a few stocks and they have options, what you can do is that, let's say that you have 15% of your account inside common stock, long. Then what you can do is that on the put side, you can buy a few dated puts and you can do a spread. Now, if you guys are wondering what spread is, we touched on it inside the options podcast, but maybe something that we can do next week or the week after is we can do an options 2 podcast and go really more into depth into spreads. But what you can do is that, let's say that you have 15% of your account in exposure to the long side, so you're overexposed. That's a pretty big position. You can just buying dated puts will be fine. So especially if you're not investing in this company and you have, let's say, like a sell date, for instance, CCIV, let's say that you wanted to sell, worst case scenario, a week after the merger, then what you do is that if you bought puts for, let's say, mid-March puts, then that would give you enough time exposure so that what's the chance that they could expire worthless, but if they expire worthless, and they just keep going down, then what that means is
your core position's doing all right.
Exactly. And the other thing that you want to look at is, one, what's the IV on them? Okay, so as a rule of thumb for newer traders, I would suggest, okay, and this is something that I follow, is that not going for vol over 120, because that means that you're paying for them at a premium. So what that means is that what we saw with GME is that the stock of GME was going down, but so were the puts. And that was because the vol was way too high. They were trading inside the thousands. So as a rule of thumb, if you're trading any kind of option, you're new, and don't trade anything with a vol of over 120.
Whenever I do this hedging, everyone knows I like to keep things simple, but I know a lot about the details and a lot of things, but I feel like if I buy a SPAC at $10 and it's 10% of my portfolio, why shouldn't I do 1% of my portfolio or 10% of the position in just a $7.50 put or $8 put 2 months out? Why? Is that not? I feel like a lot of times you can kind of just judge a lot of these just by looking at to see how cheap they are compared to the other puts in the option chain.
Yeah, no, definitely. That's a really good point. And there's a few things that come into the options. And if you guys haven't listened to the options podcast yet, that's episode 10. It's crazy to think that was 20 episodes ago. But
long ass time.
Yeah, crazy. But why you don't want to do that is based on a few things. One is that SPACs, because there are limited options, say they're once a month or every other month, the vol on them is super high. So what this means is that if it's trading at like a 200 vol, then it's trading at a premium. So for instance, if the option should be $2, it's trading at $4. That's a premium. So like we saw with GME, the stock was going down, but the puts were also going down. That's because the vol was so high on them.
Yeah, I think a lot of these longer term swings, though, I don't think the IV and everything, I don't think that's going to play as much of a role into it. Just because, the first day it gets called, but if you wait a couple days, these puts and calls get just extremely cheap. I've actually considered, just so I'm not just watching SPACs go down every day, just buying some calls after some puts after the merger and after a dip, just buying calls again.
Yeah, exactly. And that, you're effectively, that's a really good strategy. And the perfect hedging strategy for something like CCIV would be to have a low delta, a low vol, and buy it, and have a sell date that you kind of want to start to scale out the position. CCIV, if you wanted to sell by the end of February, then you would have on puts for March, because if they expire worthless, then who cares, because your core position is just absolutely ripping. But in the event that something happens, like we did see with CCIV, where the stock drops 50%, well, you're going to bank on both sides. Hopefully you can limit your risk on the long side and get out, and then capitalize on those puts. And then you're winning on both sides.
Yeah, I think maybe not using CCIV as an example for right now, because I do want to get into CCIV after this. But what other ways besides just buying puts in the market we're kind of in right now is there to hedge yourself?
Yeah, so another really good way to hedge yourself, and a lot of people don't think about this, but we talk about it, is having cash, because you can buy puts against the Russell and other things like that, and you can buy VIX calls, but the VIX went to 26, so that really doesn't matter for small caps. But having cash on the sideline is another way to hedge yourself, because if it goes down, and again, we talk about it, is that if nothing has changed, then once the chart is confirmed that it's starting to curl back up, buy the dip. And that's it. That's another way to hedge yourself. And then the final way to hedge yourself is if you're sector heavy. So what this means is that if you, what was it? The big weed craze this week, or 2 weeks ago?
Yeah, you see it all the time. Everyone was in electric vehicles, and now everyone's in weed and meme stocks. So. Yeah,
electric vehicles, weed stocks, stuff like that. If you're sector heavy, then another way to hedge yourself is the uncorrelation. So, for instance, find a sector that as the sector goes up, the other sector goes down. And what you can do is that, so when EVs were at their highs or whatever, if you found the sector that was correlated against that, then you could have bought that at the low. So if EVs all started to get the air thrown out of them and come down, this sector would go up. And so, we see that a lot of times with like the large caps, and especially with the overall market, but those sectors are still inside small caps.
Yeah, and one thing I really liked is how you said just having a bunch of cash is a good way to hedge yourself, because, in tough times, they say the rich get richer, the poor get poorer. And it's because, like, the rich are buying the dip.
Yeah, exactly. And we trade, and, a lot of people that listen to our podcast primarily trade small caps, and small caps
took a 35-40% pullback.
Exactly. And they will do that twice a year minimum. So that's something to really keep in mind. That's why we always talk about, why we always want cash on the sideline.
And I feel like this one, it happened so much faster. Like in August, like I was holding a lot of penny stocks or fresh out the penny game. Just turned $1. And I think about ones like SXTC went from like 60 to 22 cents over the course of 2 to 3 months. And just all these stocks I was in, I was just watching. And that's one of the things that I was like, okay, I'm not getting caught in this downtrend again. And that's why I wanted to cut them. But it was honestly impressive how fast these small caps dropped this week, as opposed to like what we experienced in like August. Like it gave you no time.
Yeah. This was kind of like we talk. I know I talk about this a lot, but kind of like the weeds in 2017 through 2018. We kind of saw something similar, and I think we mentioned it on the algo episode, but we saw a clear tape change, and ever since then, the small caps have just been down, but. We talked about SPY, we talked about hedging, we talked about small caps. Something that I want to touch on is that it just like we were kind of seeing the sentiment change from the long side to the short side, now we're seeing everybody complain about small caps, which is the social sentiment. We talked about it, but when everyone's long, that's when we're kind of scared. And when everyone's short, that's when we're kind of thinking long. The Warren Buffett phrase, buy the fear, sell the greed. Well, now everybody's, now that everything's down 50%, everybody's really thinking.
Wait, I thought the Warren Buffett quote was buy the dip, friend.
Yeah, no. That's the other one that he's famous for.
Oh, okay. He must have said this one later. It's super probably it was probably before 2013 would have definitely gotten canceled for saying it today, but I have seen it on the internet. I know he said it. So.
Yeah, no, exactly. No, but so I think that's a really good point. Now that we're starting to see everybody complain about small caps, now that they're down 50%, that's usually when I start to look long. I still think that we have a little bit more blood in the water, but the theory that I'm kind of thinking is that SPY is going to be sell the news. And when SPY starts to go into a downtrend, or not even a downtrend, but a pullback, everybody flees to small caps. So this kind of lines up with what we're seeing. I think we still have a few days of blood inside the small caps, but if the market goes down and small caps, let's say take another like 10% hit, then the stars could align to where people start to flee to small caps and small caps start to really go again.
Yeah. I mean, you even think about like just a year ago, if SPY was going down, it seemed like small caps were skyrocketing.
Oh yeah, exactly. People make the best money in small caps in 2008. And that's because nobody wanted to touch the market. So this kind of could set up to be a perfect scenario for small caps. Small caps see this large pullback, and then all of a sudden people start to flee to small caps. And now I do think that small caps were on steroids for the last like 8 months, and I don't necessarily want to see that kind of movement. I don't want to wake up to 5,000% runners because we'll be inside the same situation.
I do.
Yeah, I know. But we'll be inside the same situation. Now there's stocks underneath $1 and things of that nature. But if we go back to that insanity, then we'll be inside the same situation that we were 3 weeks ago. So I'd like to see small caps come back, and I would like to, grab the dips, and then I would like to see the small caps specifically start to crawl back up and start to see volume really come in. Just keep that in mind, that if the market's going down more and you think that it's bad for the small caps, that's not necessarily true.
Yeah. And okay, well, I think that is a good way to kind of finish up hedging. But transitioning from hedging, we touched on it. It was such a big week last week. It almost seems like this got brushed under the rug, but we won't let it. CCIV announced its merger with Lucid Motors. It went down from $62 to a low of around 26 or 27. It's now trading in like a 31 range. Personally, I had puts and people hated me for it. My puts were just in case the rumor fell through, or if the merger fell through and Lucid was like, nah. But Lucid was like, yes, and they still hit. So what do you think caused that? Why was it such a sell the news event? And it's crazy. And Niccolo vibes.
Yeah, so it's actually like, I like the company. I think the company's fantastic. But think about it this way, okay? The brand new video game comes out, but there's only 400, let's call it, okay? And people were saying that this is going to be the best video game ever, okay? Well, everybody's bidding up the pre-order sales, and eventually it comes out, and people are like, oh, wait, why did I just pay $40 for this when this thing's worth $25? And then all of a sudden people start selling, and they're like, oh my God, like this is not what I thought it was. And let me see what kind of money I can get back, because the original starting price was $10. So that's kind of how we saw with CCIV. CCIV, okay, I like the company Lucid. I think they're going to be a good company inside the future. But right now, people were paying for a valuation that was 5 times what it should be. I mean, realistically, the stock should be trading at about, I would say, 17 to 23 based on the valuation. Now, so 27 is not, or even 30 is not, super far off, but 50 to 60, that's a big valuation. And people realized what the valuation was. And I think it was just a huge, like, everyone trying to get out at the same time. And that's really what, and also the other thing is that the stock was up massive inside the last 3 months. So when that happens, people start to get to a point to where the second that stops going up, people just flee.
Yeah, they weren't used to it ever doing anything except going straight upwards.
Exactly.
But it's definitely something crazy. I mean, we definitely threw out some warnings. Hopefully, some people took them or even hedged themselves. Sorry, we got to the hedging part a little late. But with that being said, been taking some heat, Hugh. Your swings suck. So here's a tweet, and I think this tweet is a good transition into it. I want to hear what an average trader should do if they are deep in companies they are swing trading and have conviction in, but are watching everything fall like this past week. I personally held and lost 28%. I never set mental stops because I like the companies. So a few like the TRCH and the VISLs not doing hot. A lot of the SPACs have been not doing hot for a while, to a point where, we even mentioned maybe, cut some, maybe cut them all. Trade your plan. But with that being said, how are you going to handle the swings that are down?
Yeah, I think this week was a huge wake-up call to most traders that, hey, stocks don't always just go up. And for me, a lot of people ask, like, how do I keep cool during this time? Like I said, people that have been swinging for a long time, I was never red on positions until the catalyst came. Now, even something like TRCH, I'm up like 50 cents a share. And that's even...
No, you were red on... You were never green on it until the catalyst.
Exactly. Came. Yeah. That's what I meant. Yeah. On the swings, I was never green until the catalyst came. Now, at one point on TRCH, I think we were up like 300% or something. And I was like, oh my God, this is like, I should probably put in some of my bio. What waterfalls up is going to waterfall down. And now I've seen just unrealized gains just freaking just go out the door. I guess that's kind of like the times that we're in. But that being said, we're still green on every single swing. And I think I'm down in comms and Visceral.
Well, I mean, you had to think like what for the people that aren't green on the swings.
So if you're not green, I think, and if you purely only take calls from Twitter, I think that it's important for you to understand that you are going to get in before other people. And what I mean by that is that, if you don't have hotkeys or you're not doing any research, then you're not getting in before other people. And I think that it's really important to take a breather and, really do DD. Screaming from the top of the hill that the merger is 4 weeks away, 3 to 4 weeks away. Now, if you are not green, there's something, and there's two different scenarios. You're not green, but you have a lot of cash. That's fantastic, because then what you're going to do is that you're going to wait for your stock to come down, get support, and start to curl back up. And how you do that is go back to the technical analysis podcast, the episode, pull up a chart, and you're going to sit there and you're going to identify on your swings support and resistance. Now, that's for the people that have cash. If you don't have cash, then what you're going to do is you're going to take off. You're going to make sure that you have 55 to 60% of cash from here on out. Okay, those are the rules. Okay, because that's how you're going to hedge yourself against things like this. Okay, and then what you're going to do is that you're going to evaluate everything, and you're going to say, okay, what's my opportunity cost? What's my risk? What's my why? And what's my reward? Okay, but the last is going to be your reward, because everybody always wants to think about what their reward is, but nobody ever wants to think about their risk. Okay, because there is risk involved with anything inside the stock market, anything and everything. So let's go through it. Now, Visceral and comms, okay, I'm licking my chops because, especially with Visceral, because Visceral's now getting to a point to where their market cap is going to be the same as the amount of cash that they have in hand. Let's say that again. Visceral's getting to a point to where they're having the amount of cash on hand that is equal to their market cap. Okay, all they have to do is go down like another 20 cents or something, and they're right there. So, I'm licking my chops. And I think that, something that we've been accustomed to is that chasers have been rewarded inside this market. Okay, as a swing trader, okay, you have to understand that everything is weeks out, if not months out. Who knows? TRCH, even though the CEO of Meta tweeted that they have 48% of the vote, that's great. But guess what? If the merger doesn't go through, TRCH isn't worth $2 a share. And that's really important to keep in mind, is that you have to evaluate the DD. Okay, you have to evaluate your DD. You have to evaluate your why. You have to see what your risk is. So right now, TRCH is trying to curl. If it starts to break out, it can break out quick. But again, okay, chasers have been rewarded for the last year. And if you're a chaser, okay, we pleaded with you that if you 5x'd your account the day that you took a 10% hit, to start to reevaluate your positioning. Now, I do think that small caps are getting to a point to where all of the, lack for a better word, all of the newbies are out, and that's usually when it's the time to buy. Now that we're seeing the most pain in the shortest amount of time, and now we're also seeing SPY sit at support, small caps could be close to getting to a point to where the entire market is at a point to where it can start to curl back up. I think there was only like three small caps, like green on Friday or something. So DYNT had news, went up 100% and ended like up 3%. So I think it's important to understand that when small caps go, they go. When small caps pull back, they pull back. And if this is your first market rotation, take this. Willie Meat Sauce again, shout out to him. This is your first market rotation that you've seen. This will happen twice a year. And every few years, it'll happen in a week like we're seeing now. So TRCH, I think it's important. TRCH, Vissel, Comms, ONTX. I have emails out to the investor relations. Right now it's down, because of the market and because of reverse split. I have emails out to the investor relations because I think that they will, but I want to get confirmation that they'll cancel the reverse split because, they should. That's what they should do. They should cancel the reverse split, and that's what we need to start gearing again. So if you're not green, wait for it to come. I'm talking about all swings. If you're not green, wait for it to come down to support, confirm. And if you want to, kind of do what I did on Wednesday and Thursday and trade around a core position. This will get you a little bit of cash, but then also, you can feel better about your position. When you don't know anything about, why you're buying, what's your risk, things of that nature, any red that you see, you're going to be scared. Rightfully so. I get that. But when you come into swings, or even, if you're a day trader and you come into the day trade with a plan, knowing your why, knowing your risk, knowing your reward, what's your stop loss, you physically feel better.
Yeah. And I feel like if a dip scares you, you either A, don't know enough about it, B, don't have conviction in it, or C, have way too much of your money in it.
Exactly. Here's the thing. One stock should never blow you up, and one stock should, we all get punched inside the face with different stocks. Like, for instance, if any time one of these small caps could come out with a short report or a fraud case or
hell, ONT. I mean, we're talking about ONTX right now. Just 6 months ago, it dropped 70% in 10 minutes. So
yeah. Exactly. So I think it's really important that we keep these things in mind. Like I said, chasers have been rewarded, but now that we're starting to come back to reality here, now we're back to reality, and it's time to pay. The market said, I'm taking my tuition. I think we literally said it last week that the market hasn't taken any market tuition, and this week it certainly did. So mind your risk. Know what you're swinging. Know why you're swinging it. Or same thing for day trades. Why are you day trading it? What is your edge? You have to ask yourself, why am I in this stock? What is my edge on this stock? Or am I just in this stock to be in this stock? And if you can't answer the questions that we just talked about, it's time to go back to the strategy drawing board.
Yep. Okay, and to the last segment of this episode is going to be Q&A. We haven't done this in a while, so it should be fun. And we're going to try and keep each of them to around 2 to 3 minutes apiece. So should it be nice, concise little answers. So the first one is from the little dog. And he asked, how did you know to go mainly cash before the drop? Did you sell in pre-market before the major cash, or did you cash out on the jump after the first dip before second? For that one, I mentioned it last week that I was down to around 25% in position. So I had 75% cash, just due to how shaky the market started to seem. It was the first week that it didn't go straight up. And, SPACs were one of the biggest things taking me down. I said, I don't want to get caught in another August. So I trimmed a bunch. And then we saw, Wednesday or whatever happened. And by that time, I had already taken out a little bit more cash just on some pops. So I guess, it was a mixture of luck and not wanting to get caught in a downtrend.
Yeah, and I think that this is a really good time to go back to that algo episode that we did. I literally remember exactly what we said. We saw a clear tape change inside. I think it was Wednesday or Thursday 2 weeks ago. And ever since then, things have been hurting. And so I think I thought that was going to be primarily for the chasers and the day traders. I did not expect this for the small caps. But, I've been 60% cash since really September. And that just comes down to my strategy. I don't really necessarily hedge my positions, but how I hedge is having cash on the sideline and having a lot of cash on the sideline. Unless we see a massive drawdown inside the market, I'll probably always have minimum 35-40% in cash.
Okay. When you don't have the funds to get in and out of trades frequently due to PDT, what strategies to deploy in this type of environment? By Raider785. I think cash account is definitely a good way to go, or just swinging. I think that those are your only two options.
Well, yeah, and the other option is to open up with multiple brokers and spread your money around.
Oh, yeah.
And so this will give you, if you have 3 brokers, this gives you, what is it? It's 9 day trades. Yeah, so you get 9 day trades, and so that's if you're a day trader. I used to be much more risky when I had a smaller account, and I was all for the maximum growth, but also noting that it was maximum risk because, if I had put 30% of my account into a stock and that stock took a 50% hit, then that was 15% of my portfolio. So I think it really depends on your strategy, how close you are to PDT. If you're far away and you're a day trader, I would open up 3 accounts. If you are really close, then maybe, you start really thinking about a strategy for after PDT. Something to note, guys, is that, getting over that 25K mark is a huge accomplishment. And I don't want to take anything away from that. But one of the biggest things for traders is that they get over PDT and within a week or two, they're back underneath 20,000. And that's because you had a process that worked and you leaned away from that process. So if I were you guys, I would be creating strategies for that don't matter if you have PDT or not. If you're a swinger, you're a swinger.
Okay, I Love Red Velvet asked, when being down by a lot on one main position, would you recommend buying the dip until the money run out or put some money on a new position? That's to not lock money in one stock.
Yes.
Do not ever, do not keep adding until your money goes zero. That's not a good idea.
And we haven't said this saying in a while, but start with beer money. If you guys are asking that kind of a question, I would definitely think about starting, maybe only having $1,000 inside your account. Because right now we're seeing new traders come into the market with 10 grand and 5 exit. And, someone added me inside the Discord the other day and said, hey, you, thanks for all your help. Like, I turned 10 grand to 50K. Like, now I'm rich. And I was like, what? And he was like, yeah. And he showed me his account and it was literally opened January 1st. So we're seeing a lot of that. But as we come back to reality, it's important to note that you should start with beer money, something small. But specifically to answer your question, because I don't want to leave you out high and dry, is, again, wait for it to come, identify your support and resistance, wait for it to come down to support, always have cash, always. That's not a question. Always have cash, no margin. Wait for it to come down. And then once it bounces off support and curls over that smaller resistance, that's when you can add. But don't just add every dip because it can keep dipping. Okay, all of this stuff can keep dipping. You need confirmation that it's curling back up. And not just a little curl, you need confirmation that it's broken resistance to the upside.
Okay, Mr. Anderson asked, how to know when SPY will bounce versus keep dropping? And whenever you find out, let me know. Because I think you need a crystal ball and hella good charting skills.
Yeah. Same thing, guys. Okay. Trading is all about being reactive. Okay. One of the biggest things why 10,000 hedge funds blew up inside 2008 was because they kept buying the dip. Okay. And they weren't waiting for confirmation. Okay. SPY, it's sitting at support right now. Now, am I buying this dip? No. Do I think that this is a buyable dip? Potentially. But until we get over, I don't have the chart pulled up in front of me, but until we get over that smaller resistance at 385, Who knows? It's 360 or 385 right now, in my opinion. So until it gets underneath that 385, we don't know. And even once it gets over 385, that's just a confirmation. That's not an all in, let's go to 420. So just like we said with your swings or even your day trades, identify support. And then when it comes down and it starts to bounce, wait for the confirmation underneath the resistance point.
B-Rep asks, explain if you are red on a swing that you believe in, would you sell and not be able to rebuy or hold through the dip? I think that's a position sizing.
Yeah, that's all about how much cash you have, how much of your position, and also do you know about your DD? Okay, sometimes swings are freaking fantastic because of the market, and sometimes they downright suck because the market sucks. That's something that you have to ask yourself. What's my risk? Why am I swinging this? What's my reward? Where's the support and resistance? There, you got to ask yourself these questions.
What to look for in the market to tell you when a good time to re-enter long swings. For example, SPY not dropping below uptrend lines and how to just generally avoid bull traps due to market weakness.
Yep, same thing. So SPY comes down to support. It starts to crawl back up. It gets underneath that first resistance point. That's when you have your confirmation. Now, if the way to tell a bull trap is nobody ever tells a bull trap. That's why it's called a bull trap or even a bear trap. But that's when you start to mind your risk. So if it comes into that support, it starts to bounce. It gets underneath that resistance point, and then all of a sudden you're seeing signs that it's not going to keep above that resistance point. Fine. Then you start to scale out and you say, okay, this was a bull trap. It's not holding above this resistance line, and mind your risk. So then instead of now you've averaged down, you have less cash on the sideline and it keeps dropping. Instead, just take the 1% hit or the 2% hit and keep moving.
Yeah. Okay. Next, Dr. Robot asks, typical allotment of cash percent to have set aside. Hugh, since you do more long swings, can you touch on how you scale in and out around your core position? I know you mentioned your full thing a little earlier, but I guess if you want to do like a general, like you just wait for the dip, you wait for the confirmation, you enter, and then you sell at resistance again?
Yeah, not necessarily. So now it's starting to get to a point to where it's more feeling based, and that's that we can go back to the personality of stocks. But for newer traders, I would be as systematic as possible because you're not going to have that that sixth sense. And Zach Morris has that sixth sense. A lot of good traders have that sixth sense, but until you get to that point, you need to have a systematic approach. And I think the best systematic approach, especially if you're swing trading, is to have minimum 35 to 40% cash at all times. This ensures that even if things go to hell and your entire portfolio, Amazon goes to zero, Walmart goes to zero, this one goes to zero, your entire portfolio goes to zero, you have something there. Something else to keep in mind, guys, the stock market has never not made a new high. Think about that. The stock market has never not made a new high. So it's rigged to the long side. Your portfolio is never going to go to zero, but it's all about managing your positions. So intraday, sure, I'll go above. I think I said Wednesday, I was actually on margin for a minute. But at the end of the day, if you're supposed to be 40% cash, you make it happen.
Okay, 3 more questions. I'll go for the fun one first for us. Cabaret asks, regarding weekend learning and lifestyle, and then they provide an A, B, and C. A, DD learning and charting. B, trade crypto on the weekend, stay good with technicals. C, family, friends, and hobbies. Which? In other words, after an ugly market week, should you double down or get away on the weekend? I played a lot of golf with friends this weekend. Support night. I drank a little. I went out on Friday. I haven't looked at stocks at all.
Yeah, I mean, I'm a little different because I like to go over everything and I like to see where I went wrong. What I think is going to happen. So for me, but on the days where I get frustrated, I go for long walks, and that's because I can't sit in front of the screen, try and revenge trade or things of that nature because I just get so frustrated with myself. And it's not I don't get angry. I just get frustrated because I look back and I'm like, fuck, like I should have done that. I should have done this. Why didn't I do this? This was a clear sign to do this. This was a clear sign to cut that SPY option, things of that nature. So I do like to do it, but the second that I get frustrated and the second that I'm not making headway inside the learning, that's when I go for a long walk and I shut down the screens and I take a day or two, or sometimes hell, I'll take a week. But again, don't double down. This
was one of those weeks where I was like, I knew I felt that there were so many weeks in August where I was like, damn, if I just cut out Monday, I would end this week and I would just have $7,000 that would not be just given back to the market. And I was like, that is I'm never letting it happen again. And so there were 3 days this week where I only made 2 trades, 1 buy, 1 sell. And, I ended up green on those days where it was just like totally bloody. And I think just going totally different just is such a big thing for my mental state.
Yeah. You got to keep the mental state in check, and you can't get, not only the monetary factor, but it's the psychological. At this point, some days I'm pissing away Ferraris, but it's keeping that mental in check that they're numbers and that you're scaling up. And even though it's your biggest red day, you also just had your biggest green day. Yeah. And it's things like that, keeping that in mind.
Okay. We got 2 more. We're going to do these quick. 1, when to cut ties versus when to diamond hands. Take it away.
Yeah, I think it comes back. I don't like those trades, but I think again, it comes back to knowing why you're holding it. What's your risk, things of that nature.
But when does it go different? Like, what could you give an example of Vissel?
I'm not riding down with any stock.
Cutting ties. Okay.
Oh, I won't be cutting ties with. Okay. Yeah, I understand now. A lot of people ask about my stop loss, and I don't have a stop loss on. But what I do is that I have. So my bad catalyst, if it comes out with a bad catalyst, let's say like a stock offering with warrants, then I'll usually be done with it. If it comes out with, a short report and they're claiming fraud, and I read the short report and I'm like, oh shit, like that's a shell company, I'm done with it. If it comes out with now on the flip side, a lot of people ask, what's your price target? And I don't usually give price targets. If I do, they're based on the chart, but they're obviously loose. And it depends. Usually I'll cut some if it's when the news comes that I'm waiting for. So that's kind of like my stop loss is kind of bad news catalyst. So for instance, like, if a merger doesn't go through or a Vissel comes out as a shell company, things of that nature, that would be when I would be done with stop loss. And then it gets to a certain point where if I'm holding this bag for, let's call it like 5 months, then it gets to the opportunity cost. And at a certain point, I'll say, okay, for instance, GHSI last 2 Aprils ago, or last April. Yeah. We were waiting for that news forever. And so finally got to a point where I was like, you know what, time to move on.
Yep. Okay. And the very last one, and I like how opportunity cost is one of the last things you talked about in the last one, because I think it's big here. Matthew wants to know what to do if you're still in swings and only have a small amount of cash in the account. Keep holding or sell and hope for a bigger dip.
Yeah, so that's a really good question. A lot of people run into that. You need to have more than 5% in cash. Make a systematic rule. If you're a day trader, you need to have, and you go cash at the end of every day. Intraday, you need to have 30, 40% cash, maybe even 50% cash. As a swing trader, we said, 35, 40% is usually what I do. So if you are inside that situation where you don't have a lot of cash, you need to look at your opportunity cost. Where can your money be used better? And then I would scale some of that position, especially if you're up green on it. If you're up, 50, 60%, if you're up 50, 60% and you don't know when the news is coming, maybe that's a sign to scale out a little bit. And it comes back to the questions that we talked about earlier. So if I were you, I would look at all your positions, lay out the DD, lay out your plans, and then you need to scale some back. It comes down to you have to have some cash.
Yeah, I think going forward, hopefully one thing was taught, take gains, have cash, 2 very important rules. And with that, I say, Hugh, hit the outro.
All right, guys, that's it for Pennies Going in Raw this episode. I hope you guys really enjoyed it. If you guys did enjoy this or any of our other episodes, please give us those 5 stars. It helps us out a lot. Our next goal is to get 5,000 reviews. Isn't that crazy? I feel like we were just at 500. So thank you guys. Like, comment, tell us what you didn't like, and tell us how we can make this better or what you loved. Thank you guys. See you next week.